Yes, interest rates have been steadily declining over recent months, and that is welcome for many homeowners and first-time buyers across the UK when it comes to securing a new product with a lender. But it doesn't mean you need to be on the phone to me every 5 minutes checking if you're on the best interest rate, because obviously we're going to do that. But in this video today, we're going to talk about interest rates, what might affect them, and give you the heads up so you have a little bit extra knowledge. Hi, I'm Sam Fox, a mortgage expert here in the UK, and on my YouTube channel, I share pretty much everything there is to do with property, whether it talks about buy-to-lets, first-time buyers, income protection policies, you name it. I want to help educate the whole UK and make better financial decisions when it comes to mortgages. So let's get into it, but hopefully you've liked and subscribed to make sure that you don't miss any uploads that come across every single Monday. Nice one. So going into this then, so the biggest thing that can affect interest rates, let's start with the base rate. Now the base rate is set by the Bank of England, which is effectively the cost of borrowing and savings and a whole lot of other things. Now if you want a video on this, let me know in the comments and we'll break it down in a 4 or 5 minute video so you understand what the Bank of England is and what impact they can have. But recently they dropped the interest rates by about 0.25%. Well, not about, it was actually 0.25%, which means immediately the next day, anybody on a tracker rate or a product that is affected directly by that can reduce pretty much the day after the interest rate they change. So when the rate drops, people usually bang on the phone to us saying, secure me a new rate. The rates are dropped by 0.25. What does that affect me? But 98, 99% of the public tend to go for a fixed rate, and fixed rate mortgages tend to be a little bit different and unaffected. Well, kind of affected a little bit by the Bank of England, but not immediately. So 2 things for that. If you're currently in a fixed rate and the Bank of England drop their rate, because you're fixed and you've got a pre-contractual obligation to pay that money back at the agreed rate, you won't benefit from the changes. But if you're applying for a new mortgage and the lenders have a look at their mortgage book and their mortgage products and they can pass that offering on to future borrowers, then you might see products on the market getting a slight little drop on that front as well. Now, it's not the only thing the Bank of England that can affect interest rates. Competition is a massive thing. So let's take, for example, you've got a lender, let's use Barclays for the example. They might be funded totally different to the likes of Nationwide. Well, actually they would be. Now, Barclays might have a tranche of money that they have access to. They want to lend it all out and they want to be the market leading rate. And they want to fill up their books with £25 million worth of lending at this rate of, let's say, 4.99%. They'll drop that interest rate cheaper than anybody else. Mortgage advisors like us will let the clients know, everybody will secure that interest rate. And once they get into capacity and their underwriters are really busy and the service levels drop, they'll ease that off and they'll increase their rates, meaning they're not the top of the shop for the interest. And then what might happen is Santander might pop up at the top, NatWest might pop up at the top. So competition can always drive those rates lower. And if one of the big boys comes through, let's say Halifax, with a rate of 3.5%, you can probably look around the market and think somebody else is probably going to drop their rates at some point soon as well. So the Bank of England base rate dropped them as well, but competition has a massive impact. So what the hell has been going on with interest rates at the moment? So in broad terms, rates today are actually pretty solid in comparison to history. So if we look at maybe 6, 7, 8, 9, 10 years ago, if you secured a rate of 4%, you probably wouldn't bat an eyelid. However, our little friend COVID a few years back put a weird spin on the world of finance, and we were seeing rates fixed at 0.99%, which is mad. Probably never going to happen again. So if we have a look past the last 12, 18 months, in July 2024, the average interest rate for a first-time buyer product with a 10% deposit would have been somewhere around 5.66 to 6.08% on an interest rate on a fixed deal, which you might think, that's a little bit expensive. But if we look at today's rates in a very similar scenario, 90% purchase, first-time buyer looking at a fixed deal, you're looking at interest rates around 4.71%, which, if you work out the calculations, is a pretty big difference considering people are now buying houses way above budgets. We're not buying the small 2-bedroom terrace to start us off. People are just going whacking a load of cash and a £500,000 house. So a 1.5% change in the interest rate is going to be a pretty big saving. So who benefits from lower rates? Well, quite easily, tracker rate mortgage borrowers usually see reductions immediately. Now, as mortgage brokers, we get emailed immediately when a Bank of England base rate has been announced. If it's been dropped, every broker in the country usually shares it across social media. And what happens to tracker rate mortgages is the next day, they'll pay a little bit less than the money that they borrow because it's directly impacted by the Bank of England base rate, plus a margin for each lender, which again, they set, and there's loads of ways that can be impacted. The next group of people that will be impacted are standard variable rate payers. Why it'd be that, don't really know, because it's extortionate, but the standard variable rate is the highest interest rate set by a lender. You're not really going to find one more expensive, and I'm talking here, lenders might have rates of say 8%, where a fixed deal might be at the moment sub 4%. So why would you want to do it? Maybe someone's coming to the end of the mortgage term, just want to get it paid off. They're not unable to be offered by a new product by the lenders. But really, these guys, if the Bank of England base rate drops, standard variable rates should drop as well. So one question we're asked all the time is, what do you think we're going to finish on by the end of the year? Well, if Donald Trump sneezes somewhere in America, over here interest rates might increase. The gas and oil price over there might impact what happens over there. And who knows what's going to happen in the next 6 months. But what we can say is all of the people who look at the property market are saying we should see interest rates continue to decline, but the world is an extremely sensitive place. So economic uncertainty can affect it, inflation pressures, market conditions can slow it down. So I would expect slow incremental changes to the interest rate rather than waking up one day and it's like, hey, we've got 2% interest rate back, boys, let's fill our boots. So it might not drop that quick, but we should see it by the back end of this year starting to tail off. So if it does drop, what does this mean for borrowers? Well, if your mortgage is variable, like I've said earlier in the video, a small rate drop could lower your monthly payments immediately. Quick win. Fixed rate borrowers should plan ahead for when the deal ends and review options for remortgaging. Now, those who are looking to remortgage, it's so important you start the process 6, maybe 7 months early. Now, I know there's brokers that'll jump up and go, oh, you can only do 3-4 months before, really. But 6-7 months put your mind at ease. And our job is to make sure that your mind is at ease when we're talking about borrowing hundreds of thousands of pounds, which is a pretty scary thing to think about. But it means that you can plan ahead. So if you're, for example, looking at a move, we can plan that. If you're looking to take a 2-year fix, we can plan that. If you want to submit an application for peace of mind, so you've secured your next mortgage, that's great. And then we can review it. So if the base rate does drop and products do change, we can change that along the way. And you've got us for the next 6 months, making sure you are fully happy with your next mortgage. And then one final point, those who are looking to buy or remortgage should monitor the deals. You absolutely should. And your mortgage advisor will do it with you as well. But don't expect instant large savings. Now, you can, if you want to, switch every time the rate drops, or every time a lender comes to the top of the pile with an interest rate, you can submit applications to them if you want to. Personally, I wouldn't do, because it might impact your credit file and another lender might say no. But sometimes the savings might be like 90p or £1.37, which means another application, maybe another set of pay slips, another set of bank statements. And if another solicitor's appointed for a remortgage, you've got to fill out all their onboarding paperwork again. So sometimes you do have to weigh up what is going to be the best thing. But as I said, if you're planning to buy the house or you're planning a remortgage working with a mortgage advisor, we can help you understand and capitalize on the best products and rates available to you at that time. Right, that's enough of my waffle today. If you do have any questions about the Bank of England, what it is that they do to vote, I could do a separate video on those. Just let me know in the comments below. And like always, please like and subscribe and share these videos. It does wonders for the channel. I'll see you soon.